Good afternoon, everyone. Thanks for joining me for today's webinar titled How to Optimize Equity Compensations for Income and Taxes. My name is Janet Wan. I'm a certified financial planner and the president of Sierra Pacific Financial Advisors. I'm also your moderator for today. To keep this webinar more interactive, we encourage you to submit questions through Q&A box. The chat function is disabled. We also take your feedback very seriously and are looking for improvement. So we appreciate that you can submit the survey at the end of the presentation. So with all of these household items have been taken care of, I'd like to introduce you today's speaker, Daniel Goodman. Daniel graduated from San Jose State University with honors in a degree of business finance and economics. He also holds an MBA degree from Santa Clara University with behavioral finance and quantitative decision method. Daniel is a certified financial planner and a chartered life underwriter. He's also the director of financial planning at Sierra Pacific Financial Advisors. Daniel has over 20 years experience, and he enjoys using his extensive financial planning and investment knowledge to help our clients achieving their goals. Daniel and his wife and 3 daughters live in Livermore, and they love gardening and then raise chickens. Some of you may also know Daniel is an avid home brewer. He used to be the small business owner of home brewer and winemaking in Livermore. So without any further ado, Daniel, I will turn the stage to you.
Thank you, Janet. Much appreciated. Good afternoon, everybody. Hope you're all doing well. So we see more people are still joining our webinar. So again, we want to thank you, everybody, for taking some time out of your day to be with us. So as you all know, you all registered. So today's topic, this quarterly webinar, is on equity compensation. So we're going to talk about strategies and tax implications of these different types of compensation that we see. Our agenda for today is we'll look at equity compensation alternatives, kind of a general overview. What are the different kinds of equity compensation? Kind of that description of non-qualified stock options, incentive stock options, and restricted stock units. We'll talk about the taxation differences among these 3 main types, and then potential strategies for exercising and selling equity rewards to generate income. So first of all, just a general overview. So with equity compensation, the benefits typically revolve around, favorable tax treatment versus a cash salary, potential for significant share price appreciation. It takes the form of company equity ownership in the company that you work for, which is always a good thing. And it's a supplement to cash salary compensation. So when we talk about favorable tax treatment versus a cash salary, obviously cash salary, that's at your ordinary income tax rate, 33%, 40%, whatever that particular bracket marginal tax rate for you might be. Whereas equity compensation at a favorable tax rate can get taxed at what's called the long-term capital gains tax rate. So if you're single, you only pay 15% federal tax if your income is between about $42,000 and about $460,000. Over $460,000, your capital gains rate long-term is 20%. If you're married filing jointly, that 15% bracket is between about $83,000 to $520,000. Anything over $520,000 is taxed at that 20% federal tax rate. And just so you know, California taxes capital gains as ordinary income. So there's no favorable tax treatment for capital gains in the state of California. So what are some of the equity compensation risks that we take on when we've got this type of compensation package? So if you work for a pre-IPO company, the major risk there is the company never goes public. Therefore, the options are worthless. They never become worth anything. Your share price on a public company or an IPO company, the share price stays below the option strike price. So again, those options have 0 value to you. And then the third is for public companies that are doing well, everything's going good. You've got the potential for equity concentration in your portfolio, and that increases portfolio risk. So these are particularly true for folks who work, Apple, Google, Tesla, companies like that. You've got a lot of RSUs, or perhaps you had some incentive stock options back in the day. You're holding a lot of Apple right now, 50, 60% of your portfolio. That's that concentration risk. And that's the part that we're going to talk about here in a little bit. Okay, what are all the various types of employee stock compensation? Because it goes beyond just the three we'll focus on today. So stock options, they give the employees the right to buy a number of shares at a fixed price at grant for a defined number of years into the future. Qualified options, best known as incentive stock options, are subject to ERISA, and they have the favorable tax treatment in that no tax is due upon the time of grant or exercise. The non-qualified options, they create a taxable event immediately upon exercise. And the tax is based on the spread, which is the difference between the strike price and the fair market value on the date of exercise. Restricted stock and its close relative restricted stock units give employees the right to acquire or receive shares by either gift or purchase once a certain restriction, such as working a certain number of years, which we call vesting, or meeting a certain performance target, are met. The performance target ones we generally see with restricted stock, and the vesting we see with those RSUs. Also, there's employee stock purchase plans, or ESPPs, and these provide employees the right to purchase company shares, usually at some discount, which normally we see about 15%. And employee payroll deferrals are used to purchase the stock at a predetermined point, for example, at the end of every quarter. And then a couple of things we are still available that we don't see so often anymore are stock appreciation rights, or SARs, and that provides the right to increase value of a designated number of shares. So that stock appreciation right, it offers the holder the right to the cash equivalent of the stock's price gain. So if the stock at one point was $10, it goes up to $20, that $10, that's the gain that you're eligible to receive. And the employers will almost always pay these out as a type of bonus in cash. They do have a vesting period, and you must recognize ordinary income on the spread at the time of exercise. And again, that spread is that price gain, that $10 on previous example. There's also what we call phantom stock, also known as shadow stock, and that pays a future cash bonus equal to the value of a certain number of shares. So no real stock is issued. What it does is the phantom stocks, they follow the price movement of the company's actual stock and then paying out any resulting profits from the price movement. And while phantom stock may be hypothetical, again, no actual stock is issued, it's more like a tracking stock, it still can pay dividends. And again, it experiences those price changes as the underlying stock changes. And then after a period of time, the cash value of the phantom stock is distributed to the participating employees. So that's kind of a general overview of the various types of employee stock options available. Okay, so today we'll start with non-qualified stock options. So the basic character of a non-qualified stock option is it's the right to buy a set number of company shares at a fixed price, and that fixed price is known as the exercise price. The stock option can be exercised on a set schedule as you work for a company over time. That's the vesting period. And upon vesting of those non-qualified options, you may exercise or you may choose not to exercise. That is completely up to you. And of course, that decision has tax implications for you. So the spread is taxed at ordinary income. And again, that spread is the market price on the exercise date minus the strike price. Upon separation of service, there is what's called a post-termination period to where you can exercise any vested, unexercised options that you hold. And then after that PTE expires, any unexercised options will expire to no value. And upon separation of service, all vesting ends. You can execute what's called a cashless exercise, and that is used to pay the cost of the exercise. So whatever that strike price is, you want to cover that, plus any taxes that might be due because an ordinary income liability has now been created. Incentive stock options. So incentive stock options are not reportable as taxable income at the time of grant nor at exercise. So that's different from the non-qualified options as well as RSUs. The ISO confers the right to buy shares of company stock at a discounted price. And that's what we call the strike price. And that strike price is normally set at a price similar to value at the time the grant is written. It also has a vesting period similar to non-qualified stock options. And the profit on the ISO is usually taxed at the favorable capital gain tax rate. Now, to qualify for that favorable tax treatment, certain conditions must be met. And we're going to talk about that in the tax comparison section later on in today's presentation. There are two key dates for tax treatment, the grant date and the exercise date. These two dates are very important. And you have the potential for an AMT liability or alternative minimum tax liability. And all that is another way to calculate a person's tax. It's calculated slightly different from your normal tax liability. There's certain add backs, so things you get to take off your normal tax return, you have to add them back to AMT. And so if the AMT liability is greater than your normal tax liability, you pay that AMT figure. So with the selling and exercising of options can push a person into that AMT territory. So we always recommend before you exercise large amounts of stock or sell large amounts of stock, you want to consult your financial professional and or your tax professional as well. Restricted stock units. So these are the ones we see the most of these days. The RSUs have replaced ISOs as the more preferred method for equity compensation. RSUs vest over a period of time, normally 4 years. So very similar in ISOs and non-qualified stock options. As with ISOs and non-qualified options, the vesting halts upon termination, but it may continue with death or disability. So that's always something that's important to talk with your HR, your compensation specialist, with your employer to find that out. RSUs do create a tax event at vesting because once the RSUs vest, all of a sudden that now turns into stock that's now given to you by your company. And so that's considered compensation by the IRS. So those values of shares for tax purposes is the fair market value of the shares on the vesting date. And the sale of shares will be taxed either as short or long-term capital gains.
So Daniel, we have one question coming, and you talk about the ISO and the non-qualified stock options as well as RSUs. Would you mind explain some characteristic of ESPP?
Oh, sure, yeah. So ESPPs or employee stock purchase plans have been around for quite some time. It's probably one of the earliest forms of stock compensation. Basically, what happens is the employer, the company wants to keep employee ownership of the company, so they will offer a discount for the employees to purchase the company stock. Usually, it's about 15%, and as I said earlier, that purchase is usually done at the end of the quarter. So whatever that price is at the end of the quarter, you'll get 15% off of that. Some ESPP plans, however, have called what's a look-back provision. They usually look back about 90 days. And so what they'll do then is they'll look at whatever the lowest price was during that 90-day period, and then they'll take 15% off that low price. So that's even a better benefit for the employee. And then the purchase plan is funded, like I said earlier, by employee deferrals, payroll deferrals, similar to your 401k plan. So they'll just take out a certain amount of dollars, 5%, 10% of salary, whatever it is you determined. They'll hold that until that quarter. And then when they make the purchase, then you now own X number of shares of stock.
Great. Thanks, Daniel.
Very welcome. That was a good question. Thank you. Okay. So now we'll look at the taxation of these three various options. So first, non-qualified stock options. So it creates ordinary income tax liability upon exercise. Now that tax is based on the difference between the strike price and the market price on the date of exercise. And we call that the bargain element. And then gains are recognized at the time of sale, will be taxed as either ordinary income or as long-term capital gain. And the difference there between long-term gain and short-term gain is your holding period. If you hold the stock for greater than 1 year, that's a long-term gain, which gets taxed at that favorable rate I mentioned earlier, 15% or 40% for those of you with over $450,000 of income. In terms of the tax at exercise, you can see here in this table, for the non-qualified option, it had a strike price of 10 and the fair market value at exercise was 30. So this delta, this $20, that's the amount you get taxed on as ordinary income tax when you exercise your non-qualified stock options. For restricted stock units, you pay ordinary income tax on the value of shares received on the vesting date. And that value is based on the market price of the shares on the vesting date. And once again, gains are recognized at the time of sale, will be taxed at ordinary income tax rates or long-term capital gains tax rates, again, depending on your holding period, less than a year, more than a year. So for the tax at vesting for an RSU, since you got it for zero, but it was worth $30. So that whole $30 is the taxable amount when those RSUs vest. Taxation for incentive stock options. Now, this is the one that trips everybody up because there's a lot of some moving parts here, but I think we'll try to demystify this a little bit. So when we talk about taxation for incentive stock options, we have two types of disposition, a qualifying disposition and a disqualifying disposition. Where you want to be is the qualifying disposition because that's the one that gives you the favorable tax treatment. So for a qualifying disposition, two things have to be true. You have to hold the stock for 2 years from the grant date and at least 1 year from exercise. So when you do that, there's no tax liability upon exercise of the option. It might create an AMT tax liability based on the difference between the strike price and the market price on the date of exercise. But you get an AMT credit that you can use in future years. So there's a bit of a bright side to the AMT calculation part. And then again, gains recognized at the time of sale are taxed at the long-term capital gains tax rate. So we have a little timeline. So here's the grant at year 0. You exercise 1 year later. So it's vested 1 year later and you exercise on that same day. You could wait if you wanted to, but in this example, we're gonna exercise on right away after 12 months. Then you wait 1 year from the date of exercise, you wait 1 year to sell the stock that you exercised here. When you do that, you meet the 2-year holding period from the grant date and you meet the holding period 1 year from exercise date. That is a qualifying disposition and you get to take everything at a long-term capital gain tax rate. A disqualifying disposition means you violated one of the first 2 rules. You either exercised before you were 1 year from the exercise date, or you didn't hold the stock for 2 years from the grant date. So again, the stock is held less than 2 years from grant date or sold less than 1 year from exercise. So now you're going to pay ordinary income tax rate on that bargain element. And remember that bargain element is the difference between the fair market value on exercise date minus your exercise price. And the recognized gains on sale may be taxed at ordinary income tax rate. Again, if you didn't hold it for more than a year. So again, on our timeline, we have a grant date at year 0. We went ahead and waited 1 year to exercise. So we met the first criteria, but we sold the stock 6 months later. So we didn't hold it for 2 years from the grant date, nor did we hold it for 1 year from the exercise date. Therefore, disqualifying disposition, everything is taxed at ordinary income tax rates.
Daniel, we have another question. Many professionals in Silicon Valley are subject to AMT tax.
Yeah.
Would you mind explain how AMT credit work?
Sure, yeah. So basically, in the US, we have 2 parallel tax systems. We have what I call kind of the normal tax system that we all know and love, and then AMT. So basically what happens is you get to take certain deductions and credits on your normal tax return that get added back on AMT. So then what you do is you calculate both these numbers, and if the AMT tax is greater than your normal tax, you pay AMT. So an example, let's say in a particular year, your normal tax due is $110,000, but your AMT is $120,000. So $10,000 difference. So you pay $120,000 in AMT. The following year, it reverses. So now your normal tax due is say $120,000 and your AMT is only 90. Okay, so we're going to pay that $110,000, right? However, we have a $10,000 credit that we earned in the prior year. So we get to take that $10,000, put it against that federal tax number that we just calculated, and we're going to pay $10,000 less. So that's how that credit works. You get to take the AMT credit against your ordinary income tax due when that number is lower than the AMT tax due.
Okay, thanks, Daniel.
Oh, you're very welcome. Yeah. Okay, so now we talked about taxes, which nobody likes. So now we can move into the income strategy part, which is the part that people like to talk about. So first, we'll look at non-qualified stock options. So we have three different approaches here. And again, there's different ways to execute sales strategies with all of these options or all these stocks. These are the ones we see the most, the ones we tend to recommend the most. So with that being said, again, non-qualified stock options, the first thing you can do is you can sell based on price. So you set an upper and a lower bound, and then you sell the shares when either boundary is broken. So that might create a short-term capital gain or a long-term capital gain. It just depends on how fast that stock price moves either up or down once you set that boundary. The second approach is a staggered approach. And so the one thing in this particular example is options tend to have a 10-year life before they expire. So what we do here in the staggered approach is we want to assume the holder delays to sell the maximum potential appreciation of shares before selling. So they want to give those shares the most amount of time they can to appreciate in value before they go and sell them. So, but also recognize that the staggered approach can be done anytime after that first year of exercise. And we say first year because we want to ensure you're getting those, those long-term capital gain treatment, and also be able to participate in some degree of price appreciation. So again, in this example here, what we would say is beginning in year 5, and this assumes a 4-year vesting schedule for that non-qualified stock option, you start selling 25% of your holdings annually on a first in, first out basis. So if you do 25%, after 4 years, you would have sold off all the stock that you had exercised previously. What this does is it spreads out the income and the tax over several years. So this potentially provides you with some tax efficiency versus, exercise and selling substantial amounts of shares all in 1 year, creating a fairly large tax hit. And in this particular case, all gains are going to be taxed at that favorable long-term capital gains tax rate. So that's the thing we keep wanting to try to do. We want to try to sell those shares that we've held over a year for that long-term gain treatment. And then the third approach is just what we call the tax efficient approach. All you do here is you just wait 1 year from exercise, and then you start selling shares as you need to or as you want to. And this ensures you qualify for that long-term capital gain preferential tax treatment. And so again, we have a little timeline. If you exercise on January 1st of 2022 and you sell before January 1st of 2023, that's a gain because you did not hold it for more than a year. If you hold it more for a year, so you sold after January 1st, 2023, that's your long-term gain, preferential tax treatment for everything sold in this bucket. Selling strategies for those ISOs. So this is also the one where people can get a little bit confused. And sometimes we need to have a real strategy around ISOs. So this is the one that we really recommend for our clients who have these incentive stock options. So the first part, generally what happens is people, when they get the ISOs, they tend to kind of hoard the options. They don't exercise them. They just kind of keep them as options. And then they'll exercise when they need some cash for a project at home, a remodel, or a kid needs to go to college, something like that. However, if what you start to do, if you've got a lot of those options kind of hanging around, is you start exercising them in a staggered manner. And so what that does is, again, that helps to spread that potential AMT tax over many years, or potentially you might avoid AMT altogether. And again, we always will say, you know, talk to your financial professional. If you don't have one, we're happy to talk to you about that. You know, engage your tax professional, because, you know, this is the stuff that we want to be tax efficient with the equity compensation we've worked so hard to earn. Okay, so when do you exercise? We're going to do it in a staggered manner, but when? And this is key to the tax planning part of the ISO strategy, is you want to exercise the ISOs either in January or February. So if the stock price declines during the calendar year, you sell the stock for a loss and you avoid the AMT. And also, it creates a capital loss bucket that you can use in future years. If, however, the stock appreciates during the year, then you sell the stock in March or April of the following year. So now because you exercise in January or February, you meet the long-term capital gain holding period, you've had it over a year, and you generate the cash you need to pay the tax liability you created the year before at a favorable tax rate. So we have that little flow chart down here. So in February 2022, you exercise some vested ISOs. Let's say the stock declines in value. In December of 2022, because you kind of ride that out as long as you can, right? You're going to sell the stocks for a loss and you avoid AMT. Because remember, AMT is that taxable year, it's that calendar year, January to December. The other example is, again, in February 2022, we exercise those vested ISOs. The stock value increases. And now in March of 2023, we're going to sell that stock for a gain. We're going to use the proceeds to pay the tax liability, and we get long-term capital gain treatment. So we're in good shape there. We've sold everything. We've got a long-term capital gain. We've actually been able to manage our tax liability. And then finally, we have RSUs. So one of the things with RSUs is we want to make sure that we look at concentration risk. So we really want to get our clients, what we recommend is avoid holding more than 10% of your company stock. So that's the first thing. Second thing is we want to, by holding more than that 10%, 40, 50, 60, which we see a lot, by the way, that creates twofold risk if the company falls on hard times. First of all, there's the potential for job loss if you get laid off, if times are really tough. And also you have significant price decline in your share. So for any of you unfortunate enough to be holding Apple right now, or Amazon, I'm sorry, you know, you're really seeing that over 2022. So what we recommend is consider RSUs as a cash bonus. So what we do here is we want to sell any unvested shares upon vesting. So the minute they vest, you do a same-day sale. So you don't hold the stock. Again, this is assuming you're right around that 10%. Then you want to sell vested shares after a holding period for 1 year. So again, we're trying to whittle down that concentration to get down to that 10%. And then what you do is you want to sell your high basis stocks first. So that has the smallest capital gain. And then we can use what's called an option collar strategy, which basically sets a floor and a ceiling around the price, kind of a bit of insurance. That strategy is beyond the scope of today's webinar, but we do have one coming up later where we are going to discuss different sales strategies and collar strategies. So Sierra Pacific Financial Advisors, just a little plug for what we do. You know, a fully integrated wealth management firm. We do investment management, of course. We also do retirement planning. We do tax planning, so you can see we've done some of that. The stock option execution strategies, we're pretty good at doing that too. Hopefully we've been able to help you understand that a little bit more. Families with kids, we do the college funding for you. We do risk analysis and risk mitigation. If you have an estate and you're worried about when the Jobs Act of 2018 sunsets here in a couple of years, what are you going to do with your estate? We can help you with estate planning. And then also we've got a corporate retirement solutions department here within the firm. That's our business to business department. And we really focus there on corporate retirement solutions for small and medium-sized businesses. which we're seeing a lot of movement in these days with now the California requires employers with more than 5 employees to have some type of corporate retirement solution. So we're really seeing a lot of excitement and a lot of questions about that and how we can help those small and medium-sized businesses. So we have a lot of excitement around that part of our business, and it's growing quite well. Okay, everybody, so that is the presentation for today. And so I do have a little disclaimer that I am required to read. And basically, just so you guys know, all investments involve risks, including possible loss of principal. And this material is for educational purposes and intended to be of general interest only and should not be construed as individual investment advice or a recommendation or solicitation to buy, sell, or hold any security or to adopt any investment strategy. It does not constitute legal or tax advice. We got a couple of minutes left, so if there's any other questions from the participants, I'm happy to take those now.
Okay, so Daniel, great information. Thank you for your presentation. And we do have a few questions coming. First one, this participant has 3 types of equity compensations: ISO, non-qualified stock options, and RSU. And he wants to know how to sell his equity compensation in a sequence in order to get the favorable tax treatment.
Oh, that's a great question. And that can be very complex a little bit because you've got all 3 types. But essentially, the trick here is for the shares you've already exercised. So you're holding a lot of shares. Again, you want to start first by looking at what has that long-term capital gain treatment. What have I held for over a year? That's your first cut. And then what you want to start looking for is, do any of those have a high cost basis? So they have the smallest capital gain. So those would be ones you might consider selling first. And you kind of work your way down the list, right? Also with 2022, the way it's been, potentially some of those employer stocks that you're holding have a loss. So now you get what's called, you've heard capital loss harvesting. Well, there's capital gain harvesting too, and it's 2 sides of the same coin. So what you can do is take those stocks that have the capital loss, you sell those, create a capital loss bucket, and then you can sell some of those low cost basis shares that you're holding. And then you just make sure those 2 things offset one another. So you can actually pay 0 tax while unwinding some of those, low cost basis shares that you've held forever and a day.
Okay, great, Daniel. You're talking about the capital loss. Actually, this participant asked questions: whether she need to sell the compensation with losses to offset other investment she had.
Oh, great. Yeah, so here's the thing. Capital losses can offset any capital gain. So the capital gain is just what it is. It doesn't matter where it came from. So for example, you've got some company shares and unfortunately they're underwater right now. So you can sell those and create that capital loss bucket, right? Then let's say also in this year, you sold a vacation home in the Hamptons. Decided we're not going to go to the Hamptons anymore. We're going to sell that. But you got a $300,000 gain on your vacation house. Well, you took a $200,000 loss on your employee stock. So you have a capital loss on the stock, you have a capital gain on the vacation home. You can actually net those 2 together. So we have a $200,000 loss, a $300,000 gain. You net it together, you have a net gain, net capital gain of $100,000. That's what you pay the tax on. So that's how you can use capital gains to offset capital losses.
Okay, good. Daniel, this capital loss also applying for business as well. Like say, if you are a business owner and you sell your business with capital gains, you also can using your investment or equity compensation with losses to offset the gains from your sale of your business. Mm-hmm. Okay, so Daniel, there's another question is, you mentioned about the option collar strategies during the presentation. And this participant like to know a little bit more about this strategy and how does an individual investors apply this strategy?
That's a great question. So, individual investors can certainly pull off this strategy. There's just a lot of moving parts. So that's why we always say, if this is something you want to look into, definitely get in touch with your financial advisor. And again, if you don't have one, here at Sierra Pacific, we're happy to meet with you and we can talk about it. But essentially what the collar strategy says is, for example, let's say I have Apple at 145, 146, I think it is today. And I'm only going to hold Apple at $110. Like that's my floor. I don't want to lose anything more than 110. So what you do is you buy a put option. And what the put option does is when the price goes below 110, it allows you to put that stock to somebody else at 110. So even if Apple were trading at $90, you still get the 110, but you have to buy that put. So the other side of that strategy is where you sell a call. So now you're going above the market price. So if if we're at 146 for Apple, you might set that call, say, for $220. So high enough that you're like the likelihood of that getting called is fairly low. And you sell that call, and the value you get from that call offsets the cost of that put. So if you do it right, you have a zero cost insurance policy on your Apple that if it goes below 110, you can put it to somebody for 110, and then you cut your losses. So it's been to set a floor for zero cost.
Okay. Option collar strategy is a great strategy if an individual investors can utilize it effectively. And it's not only generate additional income, but also provide a downside risk of concentrated stock positions. But however, due to its nature of complexity, we always recommend you to working with your financial advisors and to construct this strategy together. So Daniel, we have another good question. And this participant said, and someone told her she can donate company stock to charity. And she just wants to know what's the tax benefit of donating company stock?
Okay, yeah, that's a great question. We see a lot of that here in Silicon Valley where people are holding appreciated stock and they're not really sure what to do with it. They want to give it to charity. So the biggest thing that we see is someone will then sell their stock, they get the cash, and they donate the cash to the charity. The problem with that, though, is you just paid tax on selling that appreciation, right? We've been talking about capital gains tax throughout the presentation. So the way you actually do this to get away from that capital gains tax is you to charity, you actually give the appreciated stock to the charity. So when you gift the appreciated stock, there's no tax to you, nor is there tax to the charity. So the easiest way to do that is through what's called a donor advised fund. So what you do is you actually transfer in kind your Apple shares from your brokerage account to this donor advised fund. And the minute you do that, that's what creates the charitable deduction. And then later down the line, you can decide which 501c3 charity you want to give it to. One thing to remember, though, this only works if you're itemizing your deductions. If you're taking the standard deduction, you won't get any benefit from the charitable gift. So again, itemizing, yep, you get a charitable deduction, and that's a great way to get rid of highly appreciated stock is through that donor advised fund. Just give the stock away, don't convert to cash, and then donate the cash.
Okay, great. Daniel, thanks for answering all of these questions. And we have tried to address as many as questions we can, but time is running short. So we will answer the remaining question offline by contacting you directly. And I want to thank you everyone again for attending today's webinar. Our financial webinar are scheduled on a quarterly basis. So please register upcoming webinar when you receive the invite. Also, if you'd like to know more about more information about today's topic, or would like to schedule a consultation with advisors at Sierra Pacific, feel free to contact us either by phone or email. And then lastly, please remember to fill out the surveys when the window pop up. So once again, I thank you for your time, and I wish everyone have a great rest of the day.
Thank you very much, everybody. Have a great afternoon.